The US Federal Reserve held rates steady at roughly the 4.5% mark. But with that, notably, the 10-year versus 2-year Treasury yields were essentially on an un-inversion pathway that historically signals potential for shorter term instability. So that is, I would say, neutral on the interest rate side, but potentially a moderately bearish signal in the short term on the 10 and 2-year Treasury yield side. Also, we are seeing slower growth across the board, still some potential for rate cuts in 2025 and onward. Also notably, the Bank of Japan decided not to increase interest rates, which they had been threatening to do up until about a few weeks ago, really. So that was notable in that, as we talked about last time, the Bank of Japan increasing its interest rates has been historically a very bearish sign for the global economy. And so with that, no interest rate increases for Bank of Japan is, in my view, quite good news. Beyond that, the Fed in the US has also decided to slow quantitative tightening, which is a significant signal that they're managing liquidity pressure, but they're not removing it. So the liquidity constraints are becoming diminished, but are still significant. For crypto, I would say that this means passive investors should be considering dollar cost averaging selectively instead of applying aggressively in these current market conditions.